So the best way to understand what a blind pool fund is to let me go back and revisit how we got there, because that's the most important thing. You hit it on the head. Our job is to solve somebody's problem, right? And so in order to, in our world, that means find deals that we can invest with our investors so that we can all create wealth. That's our objective. So we're in a very competitive market, Central and Northern Florida. Everybody knows that it's a crazy market, right? So in the syndication model, that's the one that most people are familiar with in this private wealth, this private money space, right? We're not registered with the SEC. This isn't an IPO. This is very different. It has special rules that we have to follow and special criteria that it takes in terms of somebody's financial abilities to get into our deals. But let's go back to the syndication. In the syndication, you have to go find the deal. If you're the sponsor, you negotiate the deal. You convince the seller that you're going to be able to raise the money, and you put some of your own money in and just start the due diligence process. As soon as you lock down that deal, you've got to rush out, and you've got about 60 days to raise whatever capital you need to do that deal. So that's, for the sponsor, that's a pretty stressful event because you've got a short window and you better raise the money. If you don't, you're going to lose money and you're going to be in a bad situation. It's very difficult to get deals in a very competitive market if you're a syndicator, because everybody else is syndicating as well. They're doing the exact same thing. So like any business, you got to find a way to differentiate yourself. So what we said, we've been doing this now for 23 years. So we have enough experience and we understand what we're doing. We understand why we're doing it. We've got a great track record. So now we decided it was time to flip the model and give us that competitive advantage we need in a market that's very competitive. So now we created this fund. It's no different. We already defined we're going to go after BC class value add deals. It's going to be in Central and Northern Florida. We're going to target annual returns of 15%. It's going to, we define the whole terms of the fund, and then we go talk to folks and say, look, this is what we've done in the past. Here's our track record. Our existing investors have followed us. And do you want to be a part of this blind pool fund? Now, what that means is that they make a commitment to invest, say, $100,000. In our case, the minimum was $100,000 to get into the fund. So they'll make a commitment of at least $100,000, and we will then go find assets that meet the specific criteria that we've already promised that we would follow, and then we go deploy that capital. So we call the capital as we find the deals. Now, that's a good thing because that gives us a competitive advantage in that market. Now, when we approach sellers, now when we approach brokers, they know there's no equity raise risk anymore because we've already raised the money. They know how much money we have. And so every broker wants the deal to close. They don't ever want to have to be in a situation where the buyer backs out and then they got to take it back out to the market. It's just a bad situation, and that just destroys their trust with their client, which would be the seller. So we're a pretty low risk buyer for a lot of reasons. One, we already raised the money. Number two, most people that do blind pool funds, they have to have some level of experience or else people wouldn't agree to give them the money, right? You have to have proven yourself that you can do this successfully before people will, quote unquote, give you a blank check, so to speak. So we're really efficient through the buying process. So because of that, we'll call it a preferred buyer. That's not how they refer to it, but that's the best way I can think of it. And so now when we go to compete for a deal in a competitive market, we have a leg up. We have differentiated ourselves in a big way. And so now we're able to get maybe not better deals, we're able to get the deal, right? Then it makes sense and we're able to close efficiently. So that's the blind pool model. And it's most important to understand why we do it that way. And so for the investor, it's really no different than being in a syndication. The huge benefit is you're going to get a little diversification inside that fund. So in our case, as soon as we raised enough money that we were comfortable, we found our first asset, we closed the fund. Nobody else is allowed in. It's roughly $13 million, and we're going to deploy all that capital. So everybody knows what percentage they're going to get of every deal that we put into the fund. So now the investors get a little diversification inside that fund rather than go to 3 or 4 syndications. They get that diversification. If you like the content that we've shared here, please be sure to subscribe to our channel and hit the bell. So thank you again and have a wonderful day.